over the last several months, there's been a lot of attention paid to subprime auto lending. There's been numerous articles written about it. The New York Times kind of started the wave a couple, 3 months ago by writing a big front page cover magazine or style article where they did all kinds of research, the whole deal. But their assertion was the subprime automotive industry is, buying too deep, and they're, throwing caution to the wind, and in doing so, creating, in their opinion, another kind of subprime mortgage meltdown. So they're trying to make the argument that because subprime automotive lenders are buying as deeply as they have been over the last year or so, that by extension, they're creating this kind of subprime bubble. And for those of you who are buy here, pay here dealers in the audience, when subprime lenders are buying deep, that affects your business. And, so there's a lot of interplay between subprime and deep subprime when it comes to automotive lending. So what I thought we could do today is just, let's take all the mystery out of the debate and bring some good panelists, again, who need really no introduction, although Ken's about to introduce them, to help us read the tea leaves on this thing and to help us really know, is the subprime automotive bubble about to burst? And with that, Ken, I'd like to bring you up. Ken Shilson as our moderator. Thank you again. Thanks, and your PAC contribution is being processed right now.
Thank you very much, Steve. Well, first of all, our goal in this session is to help you understand what's happened in the subprime auto finance business in 13 and 14 and give you some insights into I think what's going to happen in 2015, and we want to do that in two ways. Of course, we've got some tremendous expertise up here with each of these panelists, and they're going to introduce themselves and talk. But this is going to be largely a Q&A session, so we want you to start thinking about questions that you'd like to ask because we want to hear from you, and we want you to be able to talk and ask us anything about the subprime auto finance business. So let's get started. Let's start with Chris Stinebert from AFSA. Chris, tell us a little bit about who you are in AFSA, and then we'll move through the rest of the panelists.
Sure, Ken. I had the privilege to speak to you guys last year, and ladies. But my name is Chris Stinebert. I'm with the American Financial Services Association, located just down the street at 18th and K in Washington, D.C. The association represents in the auto segment pretty much the full spectrum of auto lenders, from prime all the way down to deep subprime, from the major banks to all of the captives, to our biggest growing section of membership right now is the independent auto finance membership. So we represent all of the lenders, pretty much any car that is financed in the country. Most of those cars are, we anticipate, about 80% of those cars are financed by one of our members.
Very good. Chris, great to have you with us. Next up is Dennis Carlson with Equifax. Dennis, tell us a little bit about what you're doing with Equifax and your perspective.
Absolutely. My name is Dennis Carlson. I am the Deputy Chief Economist at Equifax, and I think everyone here probably has heard of Equifax, knows who we are, but wanted to stress our interest and our dedication to be on your team based on what we've been seeing, what we've been reading. To that end, we've published some interesting white papers that sort of debunk what was talked about around the New York Times articles. We'd love for you to stop by our table in the back when you have a chance. So when somebody says to you, this is just like the subprime mortgage crisis, you can answer, well, no, not really, and here's why. I find that the best way to handle criticism of that nature is to actually give some facts. And briefly, the situation we find ourselves in today is truly nothing like what we saw before the financial crisis. I could give you a lot of facts and figures, and I'm sure we'll talk about some of them as we go through, but rest assured, I think it's so easy to point fingers in this space. There almost seems to be no one to defend the subprime space and say this is a very important piece for a lot of Americans who found themselves on hard times, particularly after the crisis. So I just wanted you to know Equifax has your back in that.
Very good. Thanks, Dennis. Great to have you with us. And our last panelist is Sophia Koropeckyj, and Sophia is Managing Director of Moody's Analytics. So, Sophia, tell us a little bit about your role at Moody's and share with us your perspective on the subprime auto finance industry.
Okay. Good afternoon. Yes, my name is Sophia Koropeckyj. I'm an economist with Moody's Analytics, which is part of Moody's Corporation. I've been following the auto industry for many, many years, and I write about auto credit and other aspects of the auto industry. And we have a partnership with Equifax, so we take the Equifax data and forecast the trends. Yeah, and I work very closely with the ratings group in New York at Moody's Investors Service. So, you know, I get their perspective on what is going on with auto asset-backed securities. So I guess I'm going to start off today. I'm going to kickstart the conversation by talking a little bit, giving a background of what's going on, and then hopefully Chris and Dennis will chime in and correct any mistakes I've made, or just go deeper than I tend to go, because we generally look at sort of broad economic trends. So as you all know, subprime lending has rebounded very strongly during the past few years. And the reason we've seen a very, very strong rebound is because we saw a very deep dive during the recession. So what's been going on is just a natural improvement in the economy, a natural improvement in the consumer lending cycle. And lenders have been abetting this trend primarily because they have very low costs because of low interest rates and because of the very conservative lending during the recession. They have had much lower losses and profits have been very strong, so lenders have been willing to extend more loans to subprime borrowers. And and the demand from subprime borrowers has been motivated by just the improving job market and the fact that a lot of people are holding on to vehicles for a very long time. The average age of a vehicle is nearly 12 years. So people need to replace their vehicles and they have to get to work, right? So borrowers who have low incomes and need to take subprime loans, you know, it's a good thing in the economy. I mean, today when I was coming in, I was talking to a rabbi, and the rabbi said, well, it's in the Bible that, you know, you need to extend loans to people in need. So that's what we're seeing. Oh, and of course, because lenders have been making more subprime loans, we've seen an increase in delinquencies, but the delinquency rate is now no higher than it was in 2007. We've seen an increase in originations, but originations are actually in the subprime space, and I'm talking about a score, you know, below 620, so both subprime and deep subprime. It's still, originations are still like 20, or outstandings rather, are still 20% below where they were before the recession. So we're not seeing excessive amount of lending from my perspective. And we've also seen an increase in charge-offs, but the charge-off rate is really actually even lower than it was prior to the recession. So I guess I'm starting off the conversation here that we really think that this idea that, you know, we're facing an apocalypse, another bubble, is really quite overblown. And we're also seeing that lenders themselves they're self-regulating. So originations they climbed a lot earlier in the recovery, but they've been leveling off in recent quarters. And actually, borrower credit scores have improved in recent quarters. So we're not seeing an acceleration in the deterioration, but we're seeing conditions level off.
Okay, very good. Dennis or Chris, do you want to add anything to that before we start moving into some of the Q&A, and I'll make a couple of remarks?
Sure, just to piggyback on that, I think it's a great point. We have seen, while subprime lending in the auto space has been increasing, it's been, every auto lending in the entire auto space has been increasing, and that share hasn't changed. In fact, it's actually shifted upward towards the higher end or away from deep subprime and more into the, what you'd call near prime. So basically 640 to 640 to 600, 580 in that area. And so we've actually seen a gradual shift. So you'll read things. I mean, there was an article today or yesterday in the USA Today once again talking about the emergence of subprime lending. But the fact is lenders are in general getting smarter and in general making better decisions. And I think that, as pointed out, is a real positive, not only for this space, but really for America as a whole. And I think based on what the rabbi said today, we're all up here doing the Lord's work, evidently. So that's good to hear.
The only comment I wanted to make is first off, I agree with everything that has been said. But let's look at this in relative terms. I mean, in the mortgage, before the mortgage meltdown or the bubble burst in the mortgage market, you had some features of some loans that were very exotic. You had no interest loans. You had these ARM type of products. You had all kinds of what they called liar loans, or basically no documentation required. None of those things are present in auto financing. I mean, we are not exotic. The type of loans that we're making today are the same type of loans that we've been making for the last 30, 40 years. So in relative terms, are we going to see a market that continues to have ups and downs as we flow along? But we're not going to see a drop-off or a bursting of the bubble like we saw in the mortgage market. So we see a huge difference. But we see some concerns out there as we move forward in some of the areas. Certainly used car values, as far as my members are concerned, have really hurt their margins, which they've had. Things are getting very, very tight out there. We have seen an uptick as pointed out, Sophia and Dennis have both pointed out, in charge-offs and repo rates. So we are seeing a little bit of effect, and as Dennis pointed out, lenders are adjusting to these new realities.
Very good, very good. I think the thing I'd like to add is I've been studying the changes in the deep subprime market, the deep subprime being credit scores under 550, and I think what if you're working in the deep subprime, are feeling is the competition from the franchise dealers who are buying very, very deep because they're being pressured by the manufacturers to do it. Very aggressive lending from credit unions, buying extremely deep in many cases, so we've got credit union competition. And then, of course, we've got the special finance companies who are being funded in part by securitizations that are being done on Wall Street. They're borrowing the money at 1% and 2%, and then they're lending it out at 19 and 20. And by the way, they're laying it off to the investors too. So that's what you're feeling out there. That's what you're seeing. And I would suggest to you, I may not know much, and I probably don't, but I know when you're putting a 475 Beacon in a brand new Chrysler vehicle for 60 months, I know where that ends up. So the reality is that if you put too much car in the hands of too little customer, I know where that all goes. Now, let's talk about the used car values for just a second, Chris. I want to come back to that. And also, you made a great comment while we were organizing today about the change that's taking place in the contract purchase market with some of your people that are buying contracts. What's happened to pricing as they're buying contracts? Would you share that with us in the used car value?
When we say buying contracts, as far as I still think there's lots of options out there for independent dealers as far as lenders that they're working with. Perhaps you don't have as many as you did last year. Today, you still have lots of options. You still have some new money that's coming into the marketplace, some new private equity and others that are entering into the market. But the growth that you've seen when the big money of last year was of some of the companies which were trying to double their market share in a period of 12 months, you've seen some tightening as far as that's concerned. You know, you're talking about easy credit. I mean, it really talks about which side. And every time we talk about a thing, it benefits one segment and it might hurt another segment at the same time. We just need to talk about where things are really today. Then you have to determine, well, that's in my favor or that's going to work against me as we go forward. But I think you have seen, and as Sophia pointed out, a tightening of the of some underwriting that's going on out there. That's probably a good thing because it needed to happen because it was becoming a little too loose, and I think that's a reaction as we look at the experience that lenders are having. So we mentioned, I think, to Ken, that the buy here, pay here market has always been a counter-cyclical market when lending was somewhat loose and free. There was not as much need out there for the buy here, pay here segment. But as when it tightens up, there's a tremendous need. So there's that little bit of that opposite wave, this counter-cyclical wave that occurs or that we see.
Yeah. Now, do you have anything more to say about the used vehicle prices? Because from the aggregate data that I see, I don't see a plunge in used vehicle prices. That they're holding up pretty well, and they're holding up much better than...
I see where we're seeing it from the lender side is in the repo market and the auction on the resale side on the repos. And we're getting some indication that they're getting less per dollar or cents on the dollar that they were a couple years ago, but nowhere near what it has dipped to before. We look at it as an adjustment period. That's all. Yeah,
so I think that's important to point out that even though we've seen a dip, we're still in a much better situation than 10 years ago. Yes, we're seeing a dip, but it's still,
in relative terms, historical terms, fairly high.
And of course, you also point out that the repo market, I mean, that's one of the biggest risks to this segment, that you know, if prices fall, that that's going to hurt lenders if they're not getting their value back. You know, especially the way.
Well, and used cars is a lot of the reflection in those prices is the leasing. I mean, we went for several years and we had the cash for clunkers that took a lot of cars off the market, and a $3 billion investment by taxpayers, thank you. And then of leasing, which really just went away to a great extent, or was greatly reduced for an extended period of time. So people were not returning those cars. Leasing is returning to normal levels, or 25% of the marketplace now.
It's much higher.
And so all of those cars will be coming back in 2 to 3 years as well.
Dennis, anything you'd like to add on that?
Yeah, the only point I would make is that the average age of a car on the road today is 11.4 years based on the latest figures. As such, these cars do hold their value better. So I think that also factors into the equation. I mean, again, in that article I read in the USA Today, they were talking about longer loan terms. Okay, but cars are also lasting quite a bit longer as well. I mean, it's certainly not unusual to expect your car to last 10, 11, 12 years, whereas perhaps as little as 15 years ago, that would have been somewhat laughable, or you would have had to have been a mechanic yourself. So I think that factors into the equation. And I think as cars continue to improve, that the used options will continue to get better and better, which I also think is a positive for the space.
I think that, if you look at the commentary by Tom Webb and Tom Contos and others, you see that, the supply at the auction block is increasing. You've got off-lease vehicles, you've got off-rent vehicles, and just go down the Santander lane, you'll see plenty of repos out there. So the reality is that the good news for some of us is that the supply is certainly increasing, and there'll be some good vehicles out there, which I think will be an opportunity. From a special finance perspective, though, I hear them as starting to reduce their loan to collateral relationships when they're doing their underwriting, because two things. One is they want to try to adjust the return on equity, but secondly, they're concerned about the future values of used car values and the losses that they're going to suffer when they have a repossession, because the vehicle is going to be worth less. Anyone like to comment on that? Anybody?
You're
Sure.
exactly right.
Okay.
I mean that is a consideration as they're looking at trend lines. They're trying to figure out. I mean, the leasing situation is 25% of leasing, and no one truly knows where values are going to be in 2 or 3 years. So that's why the banks got out of leasing, and the captives, or most of that, is subvented in some way by the manufacturers. But there certainly is a high risk in that area.
Again, we'd like you to start developing your questions. Dennis, this one's for you. What do you think is the biggest risk and the biggest opportunity in the subprime space going forward? What do you think where's the risk, where's the opportunities going forward?
Sure, I'm glad you asked that. You know, taking away sort of regulatory pressure, you know, I'll leave that for the other experts that we've heard from. I think the biggest opportunity and biggest challenge is almost in the same space, and it all has to do with knowing who your customers are, going beyond sort of a typical credit score, using alternate forms of data, things of that nature. And I think particularly in the buy here, pay here space, there's a real sort of battle going on, and we mentioned the sort of the counter-cyclical nature between the buy here, pay here, and maybe the slightly higher subprime areas. But I think the tendency is to want to get more customers. And so as a result, you lower your down payments, or you extend financing terms. And essentially, like the conversation we had earlier where there was the balloon payment at the end, you're essentially setting up your customers to fail. Mm-hmm. And so I think the challenge here is to be lured into that almost you know, death spiral in a sense. You start to lower your down payments, you start to make easier financing terms, and then your charge-off rates start to go up. And you just continue to do that. Where I think you counter that, or I think how you solve for that, is to have more information, to leverage alternate sources of data. And of course, I'm up here. I mean, Equifax has some solutions, but I think, for instance, knowing work history is something that we're finding offers a tremendous amount of value. So understanding more than just, oh, that's a beacon score of 502. You know, there could be a very big difference in various people. So I think the dealers that will grow stronger are the ones who can leverage data the best. And I think you can't rely on gut feel any longer. The last thing I would say there is so much of life is all about incentives, and making sure that you're incenting not only your customers, but you're incenting your salespeople to do the right thing and not just put somebody in too much car. And I think you can have the best analytics in the world. It can tell you exactly what to do. But if somehow it gets pushed through to make a sale, then why did you have the analytics to begin with?
Very good, Dennis. Anyone else? Sophia,
Yeah,
would you like to add anything?
I can add a few things. I think that one of the risks is the lengthening of loans, that the average used vehicle loan is 60.9 months. And if you've got weak borrowers with very long loans, a lot can happen in those 5 years. And there is that risk that, you know, there could be a job loss in those 5 years. And with the very long loan terms, that a lot less is then paid off if the car needs to be repossessed, and at the same time, if used vehicle prices are declining, then it's much harder to recover on that loan. The loan losses can be larger for the lenders. And another risk I see is rising interest rates, because if interest rates start to rise and then demand is tempered a little bit as a result of the rising interest rates, that could, and you know, I'd love either of you to chime in, that could cause more competition for for borrowers among lenders, and that could lead to less vigilance about the type of borrower they're lending to.
Excellent.
I'd like to both of those issues. I think auto has been a little bit on money coming into the auto finance space has been aided by the spreads, I think, that hedge funds and private equity and people can make out there, because they're just searching for any kind of a spread that's better than what they can get typically. And subprime has been one of those areas that has more advantages in the area of spread. So as interest rates rise, and technically those big dollars can find other avenues to achieve those same margins or that same spread, I think that poses some risk. But the other thing that you said is we have not seen, and I'd like to ask you guys whether you see the correlation between the longer loan terms and performance, because as they've crept from 60, and I think S&P just said today that they're going to define a long-term loan as 72 months instead of 60 now on a new car. But that as you lengthen out the term, the actual term is how quickly the car is paid, or the loan is paid off. And we're seeing that there's been little change. Although the actual contract has lengthened out, we've seen little change in the actual of when that loan is paid off to the lender. So we've not seen a lot of correlation between the term and the performance. But you point out some good, we'll have to analyze that going forward, certainly.
Yeah, I mean, just to answer, Chris, we haven't seen necessarily a decrease in performance based on the length of the loan. It has been getting longer, but not Canada, for instance, at least based on the data we have available, has far higher proportion of 72-plus month loans. I just happen to know this because I happen to be researching this in the last week. Whereas recently, the most recent data we have for 2014, roughly 15.2%, I think was the number, were above 72 months. Now, this is for both new and used, whereas the Canadian data is for new only. But again, I think it still stems back to the overall usefulness of a car, the length of time it can be on the road. And so I don't think necessarily 72 months, particularly for a new car, is as much of a problem. Where I do think you get into the problem, though, most certainly, is certainly in the buy here, pay here space. Not that they're extending out to 72 months, but you have a car that inherently has a lifespan. And you're already probably on the tail end of the lifespan because you bought the car at auction for $5,500 or $6,000. You're selling it for $10,000 roughly. That car is probably not going to last 6 years or 5 years. And if there's still a loan when that car goes bad, it's probably done at that point. And so, again, it goes back to this setting up for failure. In the new car space, I think a lot of people are interested in if they get tired of their car in 5 years, they'll just roll that into the next loan if they need to. It is a risk, though. I mean, I agree both wholeheartedly with what my panelists say. I agree. But I don't think it's as big of a risk as some others.
The only thing I'd like to add on to Dennis's point is that buy here, pay here was built on relationships and the ability to finance customer repairs when they have a problem. And when you've got a 60-month loan, and one of these special finance companies is financing you and that car breaks, they're not going to help that customer fix that car. They're going to hook it, and you're going to see it out at the auction. So the reality is that the relationships, I think, that buy here, pay here has with the customers are going to help us carry through. But you're going to see repos coming back just because these people can't afford to repair those vehicles. And you know, I think that's what we're going to see in the months ahead. Do we have some questions from the audience that like to ask?
Anyone? Okay. Anthony, over here.
Thanks, Steve. Just more of a statement. I got into the business in 1977. At the time, typically it was 36 months, and it went to 42 months when I think that's in 77. Then a few years later, 48, and of course 60 was the cliff. But at some point, it's going to be a return that you cannot recoup. I'm sure wages, as we all know, have not increased. And I don't see anything changing, but yet, in order to be able to compensate the payments within the range of the customer, obviously we had to go extended time. So it's going to have to be some point that is going to play out that it won't work. That's more of a statement, but maybe you can add to that. How can we keep on going more months when wages are not changing?
You're basically saying that we can't increase the repayment and we can't increase the down payment, so all we can do is extend the term? Is that your point?
That's seemed to be the case in the last, I've been almost 30-some years, over 30 years. It's just increasing the number of the terms of payment, but nothing else changed. Obviously, the cars are getting better. I understand that, but yet at some point, it's going to have to be some adjustment somewhere.
Mm-hmm. Anybody want to take that?
Well, I think we all agree that there possibly could be, but right now the analytics are not indicating that there's a danger line. So they keep creeping it longer and longer, and as soon as they start to see a change in the performance, I think you'll see a retraction there, but so far we haven't.
Yeah, I mean,
I'm sorry. I was going to say another thing. LTVs have been climbing, and that's I guess that's another risk if people are taking on more than they can handle.
and I think, in addition, a lot of times people are buying to a number. So similar to houses, a person may spend, 20 months researching a TV, and they're going to get the absolute best price. But then they go to buy a house or even a car, and it's like, well, I can afford to pay, $88 a week or $400, whatever it is. And so it's just a natural extension, I think, to stretch out that loan. And I think Chris, your point is very well taken. Until somebody says, hey, you go over 84 months and performance drops off a cliff, it's the search for customers. It doesn't mean it's the best, doesn't mean it's the right thing to do or a good thing to do, but it will get people in the door.
Yeah, the only thing I'd add is, Anthony, what we're seeing with the increased competition out there, not only on the front end, but these people aren't paying out the same way they used to. And what we do is we get to a point in the life of the loan, and then they are given another opportunity to get another car, and they just give yours back. So, you're not getting the money, you're marking it up anyway because they're walking away. And that's where maybe the leasing market has some merit in some cases. Maybe we have to relook at our pricing model. Maybe we have to look at how much we're marking up, because if we're not collecting it anyway, are we kidding ourselves and try to squeeze more into the performance period where they are paying? So I think we've got to relook at it, and we certainly got to ask for more. They're not putting the beer or scratch-offs back when they buy those. So yeah, good point. Yeah, very good point. Sure.
I don't know that it'd be possible, but if it could be built into the credit reporting some way or another, that the mileage driven, for instance, some of the new car warranties are now 120 months, and a 72-month loan on a car with a 120-month warranty doesn't sound all that bad if a person is driving a reasonable amount of mileage, but if that could be factored into the credit reporting or in the loan application in some way, and they could limit that based on the mileage driven, that would make it another factor that you could enter into it that would make it much more reasonable, I think, to make that longer term loan.
Anybody want to comment on that? Is the question to adjust the mileage in the warranty agreements that we have to drive?
I think it goes back to Dennis's comment about big data. The more information you have, the better decisions you can make, and that might be one to take into consideration.
Yeah, I mean, the challenge, I think, specifically from a credit report perspective is that's not necessarily something that would be captured from a fair credit reporting perspective. However, I think it does drive to the point of the more information you know, and maybe there's other things out there that would give you some indication of how risky, similar to the Progressive, where you plug in the thing in your car and you get a lower insurance rate. I certainly could see something like that being an evolution.
Ken, we've got a question over here.
Okay, great.
Hi. My background prior to this was mortgage banking for over 20 years. So I saw the big wave, and I was in the midst of the whole implosion. What I do have a question, and I do have some a problem with is these in the subprime market in New York, you know, a 580 credit score, you can get a loan for 24%. New Jersey, it's 28%. So this is basically almost setting up these individuals for failure already, having these exorbitant interest rates. Isn't there a possibility maybe in the future that, you know, if this was mortgage banking, you would have FHA, you know, where you can still get a loan? There would be some PMI insurance. It could be dropped over a period of time. But to me, I'm just very sensitive to these individuals who have such low credit scores and are having such high interest rates. It's just setting them up for more failure. So I just would like to know if there's something in the future that could be set up for this, or at least thought about.
Anybody want to?
I think there's a lot to think about with that question, but
Yeah, there
I'll
are.
let one of the
Yeah.
panelists take it.
Who would like to take that? Are you suggesting regulating the interest rate caps,
Yeah.
or?
Usury rates.
You know, in the beginning, you know, so yes, we'll say they're at 580. But, you know, that could be circumstances on their credit report that can be repaired within 12 months. Maybe they had, you know, a job loss for a short period of time. So now this poor individual, you know, this man, he's got 5 kids, and he's at 25%, and he needs that car, you know, for his family. There should be something within, you know, that's reviewed, that they could have an additional backed insurance, such as a model of PMI, that could be reviewed after a period of time, and this individual could, you know, get their loan reduced.
So are you suggesting a subsidy program, subsidized
or
car buying? Anybody
or
want to take
something
that
like an or an FHA, which is subsidized federally.
FHA cars?
Do any of the buy here, pay here dealers want to answer that question?
I would,
Anyone?
I might beg
Hold
to
on.
disagree that, that I think we're proud of the vehicle finance industry, except for the case of General Motors and Chrysler and their captive subsidies. We are not subsidized in any way by the federal government. I just realized as I was saying that we just were during the Great Recession in those two major American companies. But getting back to your caps, the new Consumer Financial Protection Bureau does not have the authority under Dodd-Frank, which is their enabling legislation, to set rate caps. That was very specific. That's the purview of each state, which has their caps in each state. Some states are extremely low as like 15% in Arkansas, right. To other states that have no caps.
Right.
I think that certainly from a lender perspective, we would never want to loan money to a customer that we think is going to fail. I mean, you do, whatever rate you charge has to be affordable, fit within that disposable income of what that individual has on a monthly basis. And I think that is the important, not the rate, but the affordability, that rate, whatever it is charged, and that automobile, that individual can fit that and still afford their 5 kids and the food on the table and the other things that they need to do. I would hate to see where the government, in the form of an auto subsidy, would come in and help that family specifically pay for a car.
Yeah, I mean, I think the challenge is if you, I mean, just speaking of rate caps, you're necessarily going to, some people who could use a car and perhaps improve their credit score and either refinance the car, get it. I mean, there's opportunities there, I think, for the market, in a sense, to work. I mean, I understand what you're saying, but I think that's very similar to a lot of the articles that we've seen in terms of, there is a difference between predatory lending versus actual lending. But, Ken, I'll steal the example that I know you like to give. If you had a friend who asked you to borrow $10,000 unsecured, and you heard from a couple of your other friends that he borrowed money and didn't give it back to you, didn't give it back to them and was no good for it, how much interest would you charge to lend that person $10,000? And so, you know, again, predatory lending is very much one thing. And predatory lending, by the way, doesn't just occur if your credit score is below 620. It occurs all the way up to 840. Predatory lending is something that should absolutely not occur. The problem particularly in this space is you can have 99 perfectly satisfied relationships and customers, but it's the one that gets touted out and sort of paraded in front of the world, which I think is a little bit of a shame. But at the end of the day, I think, as Ken said, it comes down to relationships. I would argue, particularly in the buy here, pay here space, the dealers that are not building relationships and are trying to get the most interest that they possibly can are the ones that probably aren't going to survive as well into the future.
Yeah, that's a good point. And I would simply add to that I think in the deep subprime market, Paula, kind of like to what you were talking about, I don't think credit score necessarily dictates ability or interest in repaying. So I don't know that you can necessarily say this guy has a 580 credit beacon or a 420 credit beacon, and therefore we can make an assertion or an estimated guess about whether or not he is in fact going to repay that loan. So I think it's a lot more, unfortunately, it's just a lot more subjective. And I think a lot of the buy here, pay here dealers that are underwriting don't even consider credit score, you know, when they're looking at, you know, kind of booking some of their deals. I do have a question though, in terms of 2015 and beyond, do you feel like some of the big subprime lenders are going to continue to buy deep? And, you know, what kind of tax time do you guys anticipate for the upcoming tax season?
Who wants to take that?
For 2015. As Chris said earlier, I think with 2015, we're going to start seeing interest rates rise. And so there will be probably less investor interest in the securitized pools of subprime loans. And that, well, I think that will put a little bit of a constraint on the market.
Yeah, at the same time, the investors who are involved in this market have been for a long period of time, understand it, unlike the mortgage market where a lot of purchases and investment was made, not truly understanding what was in the investment. I do think there's lots more transparency in the auto space, and that investors are pretty confident of what they're getting. And the fact that there has been no losses in any of the securitizations in the subprime space going back 10 or 15 years. So
I was just harking on what you said earlier, that there'll be other opportunities for investors, you know,
absolutely.
So it won't be,
yeah, you're right.
yeah.
You're right.
Yeah, there won't be as much of a...
So you don't think
right.
they're going to be buying as deep in the next 6 to 12 months as what we've seen, just on margin, you know? Any thoughts on that? So you would agree with that? You think their interest is going elsewhere?
No, I didn't mean to indicate that. I think that there's still, and there's plenty of money out there in this space. Trying to predict what's going to happen in 2015, as Sophia can tell you, has so many different factors involved in that. I would be hard put to predict where lending is going to be in the subprime auto space a year, 12 months from now.
Steve, let me take the tax question for just a second, because I've been looking at that very closely. First of all, I think that we've got a couple of issues for the tax seasons. Number one, we have a number of expiring provisions in the tax code, which we call the extender provisions, which our lame duck Congress is going to have to address before the end of the year, or we're going to have a substantial delay. I anticipate that they will extend those provisions again, kick the can down the road, you know, as they've done in the past. So I don't think that's going to delay the tax season. However, the IRS has said that there are a number of form issues that are going to delay the tax refund season a little bit longer. I think translated somewhere around February 1st may be, you know, the start of when the tax season comes in. That's just a guess. They can't print money fast enough, I guess, but the reality is that I do think there'll be a little bit more of delay in this tax season than there was last time.
Very good. Any other questions from the audience? I know Brian has indicated that Next Gear Capital is buying deep and wide, so.
A couple of questions on the deep subprime. Do any of you follow the actual tax refunds to the deep subprime folks and what's been happening over the last couple of years there, and whether you expect that to continue? Average amount of refund to the deep subprime.
Number I heard, it was the average was over $7,000 according to TaxMax, the average refund. That's what I heard.
And is that down or up, and what do we expect to happen next year?
It's up just slightly last year.
And does that include all of the takeouts for student loans, et cetera?
Now that I don't know.
So that's gross, not net.
Right.
Thank you.
Yeah, I don't think it's net.
And well, increased employment should factor into that as well, so.
Are you hearing from your lenders any more or deeper interest in leasing of pre-owned vehicles?
Are we seeing an increase in pre-owned vehicle leasing?
Yeah, do your lenders, are they looking at that more seriously?
You know, I don't know enough about that to answer that question with you.
Are there any hybrid products that they're talking about to offset the pricing of new cars?
Hybrids?
Like a hybrid lending product?
Not that I'm aware of. Maybe Sophia or Dennis would know. What would a hybrid lending product be like?
Hybrid.
Okay, I think we got another question
I
over
think
here.
a payoff is a hybrid. Yeah.
Scott Olja.
Hey, thanks, Steve. Quick question. I know there's been some discussion around these private equity, hedge fund investment arena and securitization of auto finance contracts in the industry, which have, you know, generated a lot of cheap money to the auto finance companies. We've got more independent finance companies probably in the market than we've had historically in this industry. It's incredible. The access to cheap money is ubiquitous throughout both new and used car side. I guess the interesting thing, and one of the big correlations that Paula earlier alluded to, is that these are being securitized. They are being sold to third-party investors. Do you feel that at some point there may be a trend toward migrating to third-party servicing as well, as far as the contracts go themselves, and the lenders themselves really trying to get out from under, you know, the risk, if you will, of collection of those funds, much as what happened in the mortgage industry. So they became very aggressive in terms of market share acquisition, which is going on now. It's very frothy. They're buying very deep. At the same time, is there going to be potentially an evolution where they start to try to, you know, spin off to third parties the servicing and risk correlated to the collection of those funds? And do you see then, as a consequence of that, and obviously these private equity hedge fund entities are not under the too big to fail umbrella of Dodd-Frank, but would there be then some sort of Federal Reserve, Justice Department action that could really all of a sudden put a quelch to the whole thing and would collapse much as we saw in the mortgage industry? So just curious on your perspective.
You should talk to the New
in terms
York
of how
Times.
that might evolve going forward.
You know, one of the modifications that was made after Dodd-Frank was the new securitization regulations, where the securitizer has to retain part of that skin or part of that risk, that they can't lay it all off. And for that reason alone, I seriously question whether they would want to use a third-party servicer for those loans when they're going to be responsible ultimately for that first 5% of any tranche that would be returned. So I don't see that happening. But
Anybody else like to add? No? No? Anybody else? Steve, how are we on time? Over? Yep.
I think we're over.
Yep.
Yeah. So we're over.
Literally.
Dennis has a
I think we were fine until Scott Lelja asked that last question.
Yeah, you should have given us a multiple choice, Scott, I think.
No, I think we're good on time.
Good.
We probably need to make a move.
Well, I'd like to ask that you all give these panelists a great hand.